Hi there and welcome back. If you are planning to take the SHRM or HRCI exam, then you will need to be familiar with certain HR terms and definitions, like what is Executive Order 11246? What is Flexible Spending Account? What is an Economic Boycott? What is a Cash Flow Statement? What is Employment Practices Liability Insurance or EPLI? What is Wage Compression? What is Gain Sharing? And much more. In this video, we will be reviewing these important HR terms and definitions which you need to know to ace the SHRM or HRCI exam. So let's begin. What is Executive Order 11246? The Executive Order is a US law which prohibits federal contractors and construction contractors and subcontractors who do over $10,000 in government business in a year. It prohibits them from discriminating in employment decisions on the basis of race, color, religion, sex, sexual orientation, gender identity, or national origin. Furthermore, it also requires government contractors to take affirmative action to ensure that equal opportunity is provided in all aspects of the employment. So the important aspects to remember is that this law is applied to those construction contractors and subcontractors who are doing business with the government with a turnover of over $10,000. Next, what is a flexible spending account or FSA? An FSA is a type of savings account that allows employees to contribute a portion of their regular earnings to pay for health-related costs. Funds contributed to the account are deducted from earnings and are not subject to income and payroll taxes. Funds withdrawn from an FSA to pay qualified medical expenses are not subject to tax. The money in an FSA account must be used by the end of the plan year, but employers can offer a grace period of up to 2.5 months through March 15 of the following year. Due to the pandemic recently, the IRS will allow, or rather had allowed, employers to amend the FSA plans for 2021, either to raise the carryover amounts or extend the grace period. One of the key benefits of a flexible spending account is that the funds contributed to the account are deducted from your earnings before taxes, lowering your taxable income. As a result, regular contributions to an FSA can reduce your annual tax liability. I apologize in advance for interrupting the video right now. Just a quick message from me. If you are preparing for the SHRM exam, then consider checking out my SHRM exam study guide, the one-book learning system. I have left a link in the description of this video where you can find more details about this guide and how to use it to ace the exam. Now back to the video. What is an economic boycott? Before understanding economic boycott, let's understand what is a boycott first. A boycott is an act of voluntarily abstaining from using, buying, or dealing with a person, organization, or country as an expression of protest, usually for social or political reasons. An economic boycott can mean consumers refusing to buy a certain product or to do business with a certain company. Perhaps the most famous and one of the most effective boycotts in American history falls into this category. In 1955, Rosa Parks sparked the Montgomery bus boycott. The bus company lost 65% of their income, and the boycott was the beginning of the civil rights movement in America. The small act of defiance and the boycott that followed eventually led to the Supreme Court declaring that Alabama and Montgomery's laws requiring segregated buses was unconstitutional. Next, what is a cash flow statement? A cash flow statement is a financial statement that provides aggregate data regarding all cash inflows a company receives from its ongoing operations and external investment sources. It also includes all outflows that pay for business activities and investments during a given period. A company's financial statements offer investors and analysts a portrait of all the transactions that go through the business, where every transaction contributes to its success. The cash flow statement is believed to be the most intuitive of all the financial statements because it follows the cash made by the business in three main ways: through operations, investment, and financing. The sum of these three segments is called net cash flow. Great. If you are finding value in this video and would like to be reminded of similar videos, then consider subscribing to my channel. Like the video, leave a comment. Thanks a bunch. Let's continue. What is Employment Practices Liability Insurance, or EPLI? EPLI provides insurance protection for small businesses that hire, manage, and terminate employees. It covers expenses related to employee lawsuits. Employment Practices Liability Insurance covers your legal expenses when an employee files a lawsuit alleging discrimination, wrongful termination, harassment, or other wrongful acts. In such cases, your employment practices insurance will provide funds to cover your attorney's fees, settlement costs, legal judgments, administrative and other court costs. Most small businesses are eligible for employment practice liability insurance. However, firms that lack basic human resource policies on matters such as employment at will, discrimination, sexual or workplace harassment, and ensuring accommodations for disabled employees may have difficulty securing coverage. Also, businesses that don't use employment applications or conduct periodic employee appraisals, and those that have been the target of prior employment practices lawsuits may also not be good candidates for this type of insurance. Next, what is wage compression? Finding and retaining key talent is important to every business, but some employers may not be aware of a phenomenon that can be more detrimental to your organization than vacant positions. Wage compression refers to the situation where there is only a small difference in the pay between employees regardless of their skills, experience, or seniority, and it most often occurs in the following two scenarios. 1. A new employee is paid almost the same amount as an experienced employee for the same job, and secondly, a lower level employee is paid almost the same amount as a higher level employee, like a manager. Wage compression can lead to widespread dissatisfaction among employees, causing salary to change from a motivating to a demotivating force. This can impact productivity and lead to increased turnover, as well as decreased employee morale and potential resentment among co-workers. Next, what is gain sharing? Gain sharing is often confused with profit sharing. Although the aim behind both systems are similar, their means are not the same. In a profit-sharing system, workers receive bonuses which go up or down depending on the company's profits. In other words, the bigger the profits, the bigger the bonus for each worker. Employees also earn bonuses in a gains-sharing system. However, each worker's performance determines the size of those bonuses. For example, an employee's productivity or sales volumes may determine their bonuses. Whether or not they manage to reduce expenses may also be a determining factor. Both systems aim to give workers a share in the success of their employer. However, with gains sharing, their bonuses are more closely related to their individual performances. If you are looking to learn more about HR terms, then I recommend you check out this playlist next. Subscribe to the channel, like the video, and leave a comment. If you found value in this video, I post HR and leadership related videos every week. I will see you in the next video.